All right. So chapter 22 is about hybrid forms of business. Hybrid just means a mixture of two things, right? That's what a hybrid is. And so hybrid forms of business are really mixing some of the elements of partnerships and some of the elements of corporations. That's what they mean by hybrid form, which is interesting to me that they show this one before they do corporations. You would think you do corporations first and then say, look at this one that's the hybrid between the two. But it's because they had so many additional chapters in that book on corporations, I think that they just stuck this one in the middle. Maybe next year when I rearrange this course after the first semester of using the new book, we'll do 23 first and then 22. But anyway, so we'll learn about limited partnerships, limited liability companies, and other hybrid business forms. Really, we'll just look at the subchapter S Corp. Anyway, so limited partnerships are cool because what it does is it says, hey, maybe there's more than one type of partner. Like some partners who are really involved in the decision making of the company. So those are the ones who should bear the liability if the company makes bad decisions. But others who are really just investors in the company who should be limited in their liability. So it creates general partners and limited partners. So the general partners are the ones who provide the control and management of the company. They have unlimited liability, just like a normal partnership. Okay. In fact, a normal partnership is the legal term for it is a general partnership, meaning all the partners are general partners. Okay. And they have this fiduciary duty and duty of care, just like a regular partnership, meaning all those rules, remember from partnerships, that you don't compete against the partnership, that you put the partnership's interest before your own personal interests, and so forth. They have all of that going on for the general partners. But there's a second class of partners who all they really do is provide capital. That's a fancy way of saying they put money into the partnership. They're not an agent, meaning they can't make decisions on behalf of the partnership, and they don't have any duties toward the partnership. So if you think about it, that starts to feel more like a corporation where there's just stockholders who buy in but don't have any say in the management of the company. Some of the features, they're created by statute, so that means they can be a little different in each state. Only a handful of states, I think like 9 states, have signed on to the model legislation, like putting it in exactly. But most states have used the model legislation as the basis for theirs and then made some small adjustments for their state's particular needs. Okay. You can assign your rights to any other entity, another person or another business, as long as all the other partners agree. So if I am my limited partner and I decide I don't want my limited partnership anymore, then I could sell that partnership to somebody else. And if all the other partners say it's okay, I could do that. Most limited partnerships that I know of, what they do is they require the first person that you try to sell it to is back to the business, in essence, to the existing partners. Then if none of the general partners want it, and none of the limited partners want it, then they will authorize you to sell it to a non-partner. So that's part of the partnership agreement, right? Saying, hey, if you want to sell this, sell your share of ownership, then you sell it to one of the partners already. You're not adding a new partner without everybody being cool with it. They can withdraw with 6 months notice to all general partners. And if they do so, which in essence just means I no longer want to be part of the partnership, I'm turning my partnership back over to the business and I don't want it. Remember, in a general partnership, if a general partner does that, it creates the dissolution of the business. Unless they can work out some means of continuing it. In essence, it just kills the business and you've got to reform a new partnership. So here with a limited partner, they can just kind of walk away from it. They just have to give 6 months notice and then they're entitled to a distribution of their share of ownership. So if they owned 2%, they'd be entitled to that. What they'd probably want to do, which is usually better if the partnership is successful in making money, is to go to the other partners and say, hey, I'll sell this to you for 3% of, because it's going to provide future benefit to another partner to have a bigger share. Like, pay each year a bigger percentage, and over time it'd be worth it to them. So usually you can sell it for more. If the business is successful, you could sell it to another partner for more than what your distribution would be, because it provides benefits to them for life, in essence. Now, if it's a tiny little business, nobody wants it, then you can just say, hey, I'm withdrawing from the partnership, and you're out. They receive share of profit or losses. You'll notice the or losses. You don't just get the profits, but none of the losses. But if there's a loss in the partnership, it's not like you have to pony up more cash. It just means you get a statement saying the partnership lost this much this year, and this was the amount that's your loss. And that's actually a positive thing if you're wealthy, because that reduces your amount of income for taxes to take that loss on your tax statement. So that's actually not a bad thing. General partners usually receive a greater share of the profits and losses, and they receive some compensation for their management duties as written up in the partnership agreement. Because they're the ones who are managing and running the company, they're going to be compensated for that effort. Does that make sense? And usually they'll have, in essence, a greater share in the profits, even if they own the same amount. So let's say there's 10 of us, and we have 2 designated as general partners. Because they're taking more risk, right? They have unlimited liability. We would usually, in the partnership agreement, sort of detail the share of profit and loss they're going to get versus the share of profit and loss that the limited partners get, which will be a lesser amount, typically. And like the other form of partnership, the general partnership, they are subject to pass-through taxation. That means the partnership itself doesn't pay any taxes. Instead, whatever profits there are divided up among the partners, and they pay the taxes. Okay. What's hard about that is you don't always get a distribution equal to the amount of the profit of the business. So let's say the business makes $100,000, and the partners get together and say, we think we should take 100,000 or 50,000 of that 100,000 and reinvest it in the business. Maybe we need to buy new equipment or new whatever, and so we're just going to distribute 50% of that to everybody. Well, on your tax statement, you're still going to show your share of the $100,000 in profit, but in cash, you only received 50% of it this year. And so, but that's how it goes. So that's a limited partnership. The big feature is the fact that it separates into 2 types of partners, and the one group, the limited partners, has limited liability. Elizabeth, can you try to look more excited about this for me? Yeah, there you go. Like this. Like whenever I say something about partnerships, just like make your eyebrows go up like, oh, I hadn't expected that. Like that. That would really help me. Thank you. All right. Like, wow, limited liability partnerships. I mean, sorry, not limited. That's a limited partnership. That's different from an LLP. LLC, or limited liability company, also created by state statute. Most states are not uniform, actually. So I think this is the one, actually, where only like 9 states have signed on to the same type of legislation, and that means 41 are different. But they're all similar. The members of a limited liability company are called members, and those are the people that pay in the capital to start the business. Okay? And management, there's 2 different ways you can structure it. First is what's called member management, meaning certain members have authority to manage the business. So that's just like a partnership in the sense that the general partners manage and the limited don't, okay? And the member managers have the fiduciary duty and the duty of care. There's also what's called manager management, where the partners, or sorry, not the partners, the members of the LLC hire a non-member and compensate them to manage the affairs of the business. So in essence, it's either run by one of the members, which is another word for owner, or sometimes the owners get together and hire somebody who's not a part owner and designate them as a manager. Okay? So I know what you're thinking. You're thinking this sounds a lot like a limited partnership, right? And what's happened is these are relatively recent creations. These really didn't get popular till the 1970s, okay? And what the reason they get created is because being a corporation is costly. You have to do a lot of filing of things with the government, filing minutes from annual meetings, all these different things, shareholder information that you have to provide. So businesses tried to come up with ways, and business lawyers really, to create a partnership that was treated more like a corporation from a liability perspective, but treated more like a partnership from a tax perspective. And so that's why they're called hybrid forms. And so then they came up with the partnership, which everybody had, and they created the limited partnership, which allowed certain partners to be limited or protected in their liability by being limited partners. And then they came up with the limited liability company because it gives a couple other advantages. Number one, the IRS does not recognize LLC, limited liability company, as an entity form that they deal with. So what they do is they have you file another form with the IRS where you get to choose how you'll be treated for tax purposes. A single member LLC can choose to be treated as a sole proprietor on Schedule C, or a multiple member LLC can choose to be treated as a partnership, or a multiple member can choose to be treated as what's called a subchapter S corporation, which is a slightly different taxation. So this allows flexibility in taxation because it actually allows the members of the LLC to elect their taxation status. So that's cool, right? There's a reason my company is an LLC. This really has become of all people organizing companies and committing to some structure, this is the most popular by far. But it's not the most popular of all structures. The most popular of all structures is the one that requires nothing to do it, which means for a single member, what's called a sole proprietorship, which means I had to do nothing to become a sole proprietorship other than start selling something to somebody, or for multiple people, partnerships. So those still make up the majority of business formations because they're the default, right? If you start a business and you don't file with the state, then you're either a sole proprietor or a partnership. So to say, hey, I'm a limited partnership or a limited liability company requires filling out paperwork, getting it approved by the state, and then going forward from there. All right. Some of the features of LLC: profits and losses are allocated according to the operating agreement. In other words, we say, here's how much each member is going to get. Usually that's based upon their amount of capital contribution. So if two members put in the same amount of capital, typically they both get 50-50 on the profits. But you could say, like in my case, my business is a limited liability company, taxed as a partnership, because that's what fits our needs right now. We each paid in 50% of the capital, but I'm the member manager. My mother isn't. She's just a member. So could we say I get 60% of the profits because to compensate me for the extra work of managing the company? Sure, we could, but we didn't because it's my mom. Anyway, but so it's allocated according to the operating agreement. Members enjoy limited liability to outside entities, regardless of their level of participation. Here's another way it's different from a limited liability partnership or a limited partnership. In a limited partnership, general partners have unlimited liability. Limited partners have limited liability. In an LLC, even the member manager has limited liability. Meaning if I'm acting within the scope of my management duties and let's say someone's on our property and an accident occurs and they're hurt and they sue us. Well, they're not suing me. They're not suing Mike Fox. They're suing Fox Storage LLC. So their recovery would be limited to my insurance company, whatever amount of insurance I have for bodily injury, plus the business's assets, not my personal assets, so long as I'm functioning properly within my capacity as a manager. So even as a manager, I have limited liability. Well, that's a big deal. Okay, so that ability to have limited liability regardless of level of participation and to have flexibility in electing my tax status is why people are going to the LLC. That's why it's the most popular form. You actually enjoy limited liability to other members of the LLC as well. In other words, if you're acting appropriately within your function and say business goes bad, they can't sue you for that. Though only in case of gross negligence or intentional misconduct might you be liable to the other members of the LLC, which makes sense. If you steal from them, then you're liable to them. Or if you make some kind of grossly incompetent decision that no normal person would have made, then clearly. And then, like I said, LLCs elect their tax treatment. So that's the features of an LLC. And then there's a couple other forms in the book. I only wanted to cover this one because the others I think are more specialized. This is called a subchapter S corporations. It's subchapter S of the IRS code, where it talks about is it the code or is it? I think it's the IRS code, where it talks about how corporations are taxed. And small corporations, less than 100 shareholders, can be considered what's called a subchapter S corporation. The shareholders are limited to individuals and to states, so it can't be owned by other corporations. Whereas partnerships and limited partnerships and LLCs, larger entities can actually still be members of an LLC. So with an S corp, it's limited to just like regular people and shareholders. There's only one class of stock. Those of you who take an accounting know the difference maybe between common stock and preferred stock. Okay. Well, S corps don't have preferred stock. They only have the one class of stock. It's capitalized by the shareholders like any other corporation, but it has pass-through taxation. When we get to corporations in a minute, you'll see the difference. Corporations are double taxed, meaning they file an income tax return and they pay taxes on it. Then they pass through the profits to the shareholders in the form of dividends, and the shareholders put the dividends on their taxes and pay taxes on it again. So this allows for pass-through taxation, and then the shareholders enjoy limited liability like in other corporations. So the big advantage to this one is not listed in their bullet points that they had in the book. Although, I'm trying to think, we might be able to do it in an LLC. Here's what it lets us do. When we separate ourselves from the business entity, one of the big challenges of being self-employed is something called self-employment tax. Self-employment tax is the same tax that everybody else pays with their Social Security and their Medicare. Okay, so everybody pays 7.65% Social Security and another 1.45, whatever it comes out to, in Medicare. Then their employer matches that same amount. So you're talking about 16 to 17% in tax between what you pay and what your employer pays. Well, guess what happens if you're self-employed? You pay the individual part plus the employer part. 16% is huge, right? If you made $100,000 a year, you're talking $16,000. So if there was some way to shelter a portion of that and have it not be subject to Social Security and Medicare tax, most people would consider that a good thing. So if you make yourself an employee of the company and then pay yourself a reasonable wage for the work you do, for example, my wife's business right now, it's just a partnership. Actually, it's just a sole proprietorship, but we're switching it to an LLC, and we'll choose to be taxed as an S corp so that we can make her an employee of it and pay her a paycheck. Because right now she's working on a mural. She's got a little one she's doing out in Pima she won't make much on that, $500 maybe. She does a lot of local ones pretty cheap, but she's also got a hospital up in Flagstaff that she'll probably make $7,000 to $10,000 on. She'll probably put something like 100 hours of work into that. So $10,000 divided by 100 hours is $100 an hour, right? Sounds like, and really someone in her line of work would probably get paid something more like $25 an hour, maybe 30. So what we could do is then pay her $30 an hour for her work, and the business will pay the Social Security and Medicare on its half, and she'll pay the other, so we'll get double tax, so to speak, for that. But the remaining $70 an hour will remain an asset of the business. And then we can pay that out to the owners of the business as a dividend. Dividends are taxed at a lesser rate. Okay, first of all, it's not income. In fact, it's taxed at 15%. 15? I'd have to double check it right now. Or so, 15% total, whereas any money she gets paid that comes to her directly is taxed at our tax rate, which is 28%, plus the self-employment tax, which is another 15. So you could see, or another 18 almost. So you could see how getting it down to 15% total would be a huge advantage to us. Even on that $10,000, it's going to save us several $1,000s in tax. So that's the big one. That they don't really get into the tax side of it. I guess maybe they just want to say, hey, there's positive tax implications and leave it at that, which is probably appropriate. But because of what I do, that's the area I'm stronger in, actually, is understanding the tax benefit. And so that's the end of chapter 22. That's the hybrid forms of business. Now we will